Chairman, and thank you, Chairman Bernanke, for joining us again. Just a quick sort of follow-up on the nature of a very accommodative monetary policy. Isn't it true as a general matter that a very accommodative monetary policy has the tendency, to the extent that it's successful at all, to bring economic activity that would otherwise occur in the future closer to the present day, rather than to increase the total amount of economic activity that occurs over the long run?
To some extent, that's correct. But we have a situation now where, for example, home building is well below what can be sustained in the longer term. And so the more quickly we can get back to that more normal level, the more quickly our economy will be at something close to full employment.
Be that as it may, I mean, I just think it's an important point to consider that the accommodative monetary policy is not really a net growth strategy. It probably has a bigger impact on the timing of economic activity than the total amount.
We're trying to mitigate the effects of the recession, but we can't affect long-term growth very much. That's right.
Right. Another point, just a quick follow-up. Senator Coates and Senator Lee alluded to asset bubbles that have occurred in the past. I think it's clear to virtually everyone that we had a residential housing bubble in the last decade. And I just worry that this extremely accommodative and unprecedented policy can manifest itself in unpredictable ways. And when we see the recent surge in housing prices, extraordinarily low yields on junk bonds, huge rally in equities, high agricultural land prices, it's not, as you point out, it's very hard to know at any point in time exactly what an asset ought to be worth, but it worries me that this is going to manifest itself in unpredictable ways. The last point I would just want to raise is you've discussed the general strategy for exiting when that day comes, but always with an implication that there will be this orderly transition. And I know you're aware of this, but I think it's important to underscore that it's hard to predict how the markets will respond when the biggest holder of fixed income securities in the history of the world decides it has to sell them. And you might decide you have to sell them. I know you may decide you can just let them run off, but that may not be enough. And I just think there's very significant risks that we're taking by accumulating a portfolio of this scale. Do you want to just comment on that briefly?
Well, I don't disagree that this is not easy and requires good communication. We've improved our communication.
And by the way, I'd like to commend you for that. You have provided, I think, more transparency and more communication and more guidance than the Fed has, to my knowledge, ever provided, certainly in recent history, and I do think that's constructive.
Thank you. I guess I would just say that there's no risk-free strategy here. I mean, inflation is 1%. Unemployment is still high. So we could tighten monetary policy and address some of the issues that you have in mind. I think it would also include a big market correction if we moved very quickly and unexpectedly.
Which might suggest that the reason the market's where it is because of the monetary policy.
Well, but maybe because the market thinks that monetary policy is creating more profits and growth. That's the question.
A quick follow-up to comments you've made in the past about the swaps push-out provision in Dodd-Frank. I have legislation to allow that much, not all, but much of that activity that's currently required to be pushed out to occur back in the banks, which I think is a better way for financial institutions to manage risk and a better way for end users to be able to use these products. Do you still share the view that it's a good idea to repeal parts of the swap push-out?
Yes, the Federal Reserve had concerns about this prior to the enactment of the law, and we still have concerns about it.
Okay, last thing I want to mention is there are August 9th to only 11 minutes of an FOMC meeting that contain notes on an August 1 video conference in which there's a reference, and I'm going to read, I'll quote from a portion of it, refers to, quote, plans that the Federal Reserve and the Treasury had developed regarding the processing of federal payments, potential implications for bank supervision and regulatory policies, and possible actions that the Federal Reserve could take if disruptions to market functioning posed a threat to the Federal Reserve's economic objectives. Of course, this was in the context of the debt limit impasse. So clearly, there were plans regarding how to deal with processing of Fed payments, for instance, and other things. Could you give us a sense of what those plans consist of and what you can tell us about those plans?
Well, my memory won't be complete, but we looked at our systems and our ability to, make payments to principal and interest holders. For the most part, found that we were able to do that with a few possible exceptions, people holding savings bonds and a few things that are not as easily connected to the system. We also had some discussion of the kind of policy we would have with banks. For example, discount window lending. Would we accept a defaulted treasury, and all kinds of things that were contingency planning in case that this were to happen. What we did not do was directly engage the private sector for any contingency planning. We were mostly looking at our internal systems and our ability to address whatever directions. We are the agent, of course, of the Treasury, and it's our job to do whatever they tell us to do. And we were just working through our capacity, both as an agent and managing the payment system, and also as a bank supervisor to deal with a possible default if the debt ceiling was not raised.
Okay, I see my time's expired. Thank you, Mr. Chairman.
Thank you, sir. Former Chair.